Hello, and welcome to Portfolio Matters, monthly 10-minute investment summary for July 2023. Now, before I get going, a quick reminder that nothing contained in this podcast constitutes investment advice. Please do your own research, and a full disclaimer can be found at the end. Okay, one-line summary. Continue to be cautious. The safest hold is cash, but inflation in the UK remains high. Hold as much of that cash as you can in short-dated index-linked gilts. It is too late to buy equities and too early to buy bonds, although the time to buy bonds is fast approaching. There is very little new this month. So that means that in the US, the outlook continues to be highly uncertain. This week, the Fed raised interest rates again by 25 basis points and indicated that it may be the last, but left the door open to further interest rate rises if required. It said it would be data dependent from now on. The markets believe that US interest rates have peaked. Leading indicators continue to remain very negative, but current data continues to be resilient. The yield curve, the Fed's own recession prediction models, etc., all continue to forecast recession later in the year, but equity markets are happily ignoring them and heading up. In the US, the labor market remains tight. There has been very little change in the unemployment numbers. There's no sign of weakening of the labor market as yet. Construction sector remains strong, in part due to the reshoring of manufacturing, but frankly, the home construction market seems to be defying rising interest rates. And above all, the big fiscal deficit in the US has been supporting economic growth, and the CHIPS and IRA Acts have been supporting business investment. So these are US interest rates. The speed with which they have risen over the last year has been extraordinary, and the full effects of those rises have yet to be felt. Now, going through some PMIs. So this is the US manufacturing PMI. In July, it bounced surprisingly, but it's still below 50, indicating that US manufacturing is still in contraction. Services fell unexpectedly strongly in July, coming at 52.4 in expansion territory, but indicating that the service sector in the US is weakening. And that meant the composite weakened as well to 52. So the US economy is doing okay, but the recent strength of the economy appears to be fading. We look at Q2 GDP growth, that came in stronger than expected at 2.4% annualized. But you break down the contributors to GDP growth, you'll see that fixed asset investment and the government were big contributors. Consumption weakened substantially from Q1. The US government has been a big contributor to GDP growth in Q1, but the fiscal impulse is due to peak, and these numbers were before student loan repayments were ordered to restart starting on the 1st of September. And when those repayments restart, the fiscal impulse will turn strongly negative. So the headwinds are building for the US economy in the second half. Okay, moving on to the UK. Well, the great news for the UK is inflation appears to have peaked. So far, the UK has been resilient in the face of rising interest rates, but interest rates are still rising. The jobs market remains too tight to be compatible with the Bank of England's 2% inflation target, and therefore the Bank of England is expected to keep on raising interest rates, and with a lag, those interest rate rises will affect the economy. A recession in the UK appears unavoidable over the coming year as the delayed effects of those interest rate rises start to impact. So this is UK headline inflation. The great news is it came in below expectations at 7.9%, but 7.9% is still way above the Bank of England's 2% target. Core also came down, but only a touch to 6.9%. RPI appears to have peaked, coming in at 10.7% in June, again beating expectations. That is all good news, but UK inflation remains far too high for comfort. UK PMIs, well, unfortunately in July, the PMI for manufacturing came in at 45, i.e. recession territory and weakening. Services weakened substantially to 51.5, still growing, but weakening quickly. And so the composite came in at 50.7, barely in expansion, and the trend does not look good. Moving on to the EU. Well, the EU is already in a technical recession, having had 2 quarters of minus 0.1% GDP growth. The ECB raised interest rates by a further 25 basis points this week to 4.25%, but Christine Lagarde has now stated that she anticipates no further interest rate rises. But as you'll see, PMIs in Europe are slowing further, and it looks like the EU economy is slowing rapidly towards a recession and may already be in a recession. So these are the EU interest rates, and they have risen very quickly. Manufacturing PMI continues to weaken. Services PMI came in below expectations and is weakening again. And so the composite is now below 50, i.e. in contraction territory. Moving on to China, well, Chinese economy, having reopened after its COVID lockdowns, has been growing, but that growth is now stalling. The Chinese Communist Party has discussed the need to stimulate the economy, but as yet given no details. Bottom line is, the Chinese economy has relied very heavily on infrastructure and construction investment, and now that the housing bubble has deflated, it is very difficult to see it being reflated again. So these are Chinese manufacturing PMIs below 50. The non-manufacturing PMIs are weakening, but still in expansion territory, and therefore the general PMI is also weakening, but still in expansion territory. Very little change to our views over the past month. Please pause, take a look. Bottom line, be cautious. We are now entering the second half. Seasonality starts to work against the stock market. In the US, stock markets have had a very strong run, but that has not been due to earnings. That has been due to the extraordinary outperformance of tech, whose earnings have not kept up with their share prices. So if the US economy weakens, then you'd expect to see US equities fall. Okay, that's it. Have a good summer. Thank you for watching. Please can you press like and subscribe to the channel, and it's goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.